Hello and welcome. Before we start, please make sure to subscribe to our YouTube channel for news and updates. Investors and the financial media tend to focus on macroeconomic concerns, such as inflation, labor markets, and the Fed. While these topics are important, history shows that the economy and markets grow over long periods of time due to technological innovation and gains in productivity. What impact do new technologies tend to have on markets and investor portfolios? Innovation supports market and economic growth over time. It's understandable that investors often focus on the financing side of markets and the economy, including topics such as interest rates and Fed policy. As the accompanying chart shows, the past century has been one of unceasing technological advancement, from the first assembly lines to putting a man on the moon, to the entire world being connected on a single information network. These are all reasons why many believe that AI is the pinnacle of the information age. Today's optimism on AI stems from the idea that it could enable even more technological innovations and accelerate productivity further. So far, examples of AI-boosted productivity in the business world have mainly been in the form of generating content, automating tasks, and analyzing data. It's hard to predict exactly what impact AI will eventually have, partly due to the pace of advancement, and partly because the impact of new technologies is simply hard to imagine. What's clear from the chart above is that the stock market did not move up in a straight line with past innovations, and many of their effects took years to materialize. AI stocks have outperformed, but other sectors are benefiting too. As computer scientist Roy Amara said, investors tend to overestimate the impact of technology in the short term and underestimate the effect in the long run. In hindsight, investor capital was clearly not put to its best use despite the promises of outsized returns. The challenge is knowing if there is a bubble to begin with. Today, some are rebranding themselves as AI companies, updating their websites, and using .ai domain names, no different than in the 1990s and 1960s. The performance of large-cap stocks has been driven by a handful of companies related to technology and AI, including the Magnificent Seven. There are clear differences between today's market and the dot-com bubble, the most important being that many large-cap companies benefiting from these trends are highly profitable. Having too narrow a focus on AI trends, at the expense of overall portfolio diversification, can be problematic for investors as they work toward their long-term goals. Productivity is what drives long-run economic growth. Having a short-term perspective is also problematic because the benefits of past technological innovations were much broader than a few stocks over a year or two. For instance, the benefit of the information technology revolution, driven by the rise of personal computers and the growth of Internet adoption, was not, in hindsight, just concentrated in a few dot-com stocks in the 1990s. Why is productivity so important? In short, productivity allows us to do more with less. In a recent paper, MIT economist Daron Acemoglu argues that AI will have its biggest impact if it results in new, higher-value tasks for workers, but that these benefits are not foregone conclusions, nor are they likely to be on the scale that some predict. It's important for long-term investors to maintain a broader perspective and not get caught up in the day-to-day hype. The bottom line? History suggests it's still important to remain diversified amid market exuberance. Doing so allows investors to benefit from recent trends around AI innovations while also positioning their portfolios for long-run growth. Thank you for listening. For additional information, please visit mraadvisory.com.